You wrote every single page of a 12-page investment memo, but the partner reading it on his flight to Menlo Park is the only name that will appear on the term sheet by Friday. You are 23, and you've just ghostwritten your first multi-million-dollar deal. You are 23, base salary $95,000, and your actual job title on paper, Deal Analyst, describes almost none of what you do. You cold email 40 founders a week. 4 respond. 1 takes the call. You build a comp table, a market map, and a first pass on the thesis, and you send all of it to a partner who has met the founder for 6 minutes at a demo day and already has an opinion. Your memo becomes his memo somewhere in the forwarding chain, the same way it always does, and by the time the partner presents it in the Monday meeting, the only trace of you left in the document is a footnote citing a market size figure you spent 4 hours triangulating from 3 conflicting industry reports. The fund closes roughly 1 deal for every 100 it seriously reviews. You do not choose which 100. You surface them. The partner chooses. You keep a private spreadsheet, separate from the deal tracker everyone can see, logging which of your sourced companies get a partner meeting at all. And by month 6, the number sitting in that spreadsheet is smaller than you expected and larger than you'd admit to anyone at the fund. Your desk is 4 feet from the partner's office door, close enough to hear which calls end with an actual date on the calendar and which end with some careful shade of "not right now" that both of you already know means never. The next comp band is $140,000, and the thing that gets you there isn't the deals that closed. It's the one you found that everyone else in the market somehow missed first. Your cohort started with 6 analysts across 2 offices, and by month 9, 2 have already left for portfolio company roles, a fact the fund frames as a feature of the model, not an attrition problem, since it means the associate seats stay open for whoever's left standing. On a Thursday, you notice the partner has changed 1 sentence in your memo, softening a risk you flagged clearly into something closer to a caveat, and you consider mentioning it before the Monday meeting and decide, in the end, that the read that gets the deal through the room matters more to you right now than the one that's exactly right. You think, occasionally, about what the memo would look like, with your name still on it, by the time it reaches a term sheet, and you've never actually seen that version happen, not once. Not to you, and not to anyone else in your cohort either. $140,000, and the real change isn't the number, it's whose name goes on the outreach now. You're cold emailing founders directly under your own signature, no partner CC'd, running diligence on 6 live deals at once. And the response rate for a message from associate is measurably lower than the response rate for a message from partner, a gap nobody at the fund has ever put in writing, but every associate has independently measured by month 3. About 1 in 3 associates make senior associate inside 3 years. The fund frames the other 2, leaving as finding their passion, a phrase that means something different depending on which side of the door you're standing on when you hear it. You get your first real signal that you matter when a founder you sourced, rejected twice by the partnership before you finally got a meeting scheduled, closes a seed round with a different fund at triple the valuation your firm passed on, and your partner mentions it once, in passing, in a tone you can't quite read as regret or as a lesson, about how the ones you're most sure of are usually the ones nobody else wants yet either. You mention it to another associate over drinks, half expecting sympathy, and she tells you, flatly, that the exact same thing happened to her first sourced deal, and that at some point you stop being surprised by it and just start writing it down. You keep the memo from that deal saved in a folder you never open, for reasons you have not fully worked out and do not plan to. Months into this rank, you've started reading your own outreach messages back before sending them, the same instinct you'd use proofreading something written for someone else's approval, a habit you don't remember picking up and can't quite bring yourself to break. Your desk neighbor, a year ahead of you, tells you once, without being asked, that the response rate gap closes almost entirely the moment you make senior associate as if the fund's founders can somehow sense the promotion before it's officially announced, which you both know isn't literally true, and neither of you says so out loud. In the Monday partner meeting, you present a Series A opportunity you've been tracking for 4 months, and a partner who has never met the founder interrupts you 11 minutes in to ask why the company's customer acquisition cost has climbed 30% quarter over quarter, a number you have an answer for but not the confident, rehearsed version he's expecting. You improvise. The room moves on before you fully land it, and you spend the rest of the day replaying the exact moment you should have had that number memorized instead of just understood. Base moves to 190,000. Bonus and a small carry allocation bring total compensation to roughly 260,000 in a strong year, your first fractional stake in outcomes you won't see resolved for a decade. You sit on your first board observer seat that quarter, watching a founder you've known for 2 years field a hard question from an actual voting board member, and you notice how differently the room listens to a voting seat than an observer seat, a distinction that has nothing to do with expertise and everything to do with which line on the cap table your fund occupies. Roughly 4 in 10 senior associates make principal within 4 years. The math that actually decides it isn't written down anywhere. It's whether the deals you personally championed end up in the fund's top decile, because in venture, the fund's entire return typically traces back to 1 or 2 companies out of every 50 it backs, and nobody can tell in year 1 which 1 or 2 those will be. You think about the customer acquisition cost question for longer than the meeting itself lasted, and the following week, before any partner meeting, you start preloading every number you might be asked. A habit that, months later, has quietly become how you prepare for everything now. Sequoia and Andreessen Horowitz both pass on the same company you're championing that quarter, for reasons neither of them explains publicly, and your partnership spends 40 minutes debating whether that's a signal worth heeding or a signal worth ignoring, ultimately landing, as it usually does, on whichever answer the most senior person in the room leans toward first. Benchmark passes on the same round a month later for a different stated reason, and by the time your firm finally wires the check, 3 of the 5 investors on the cap table have already changed their minds once. That quarter, a founder you champion gets rejected by the full partnership 2 votes to 3, and you go back to him yourself instead of letting the rejection come through an associate. Sit with him for an hour, explaining exactly what would need to be true for the fund to say yes next time, which is not how rejections at your fund are normally handled and which costs you nothing except an hour you didn't strictly have to give. 18 months later, he raises a Series B from a fund you respect, at a valuation your own fund would have loved to see from the inside instead of reading about it in a press release. 320,000 base. Carry allocation meaningfully larger now. Total comp landing near 500,000, including the deals already showing paper markups. Worth somewhere between 1 and 4 million on paper, depending entirely on outcomes that won't be known for another 6 to 8 years. You're evaluated on origination the way principals everywhere are, on whether founders are calling you directly instead of going through whoever introduced you. A well-known growth fund reaches out about a principal seat with double the carry and a bigger check size, and you take 3 meetings before turning it down. Not because the offer is bad, but because you'd spend that seat writing checks into companies other funds already validated, and you've realized somewhere in those 3 meetings that you'd rather be early and wrong sometimes than late and safe always. Roughly 1 in 5 principals make partner within the standard window, and the ones who don't tend to find out slowly, through smaller check sizes and thinner deal flow, rather than through any single conversation that names the outcome directly. You think about mentioning the growth fund offer to the founder whose rejection you personally walked back, the parallel between the 2 conversations occurring to you only after both are already finished, and you conclude, on reflection, that it isn't really a parallel at all, just 2 decisions that happen to land the same month. The associate who now sits at the desk you used to occupy asks you, during a mentoring lunch, how you knew turning the growth fund down was the right call, and you tell her, honestly, that you didn't know, you just noticed which choice let you sleep at night, and built the rest of the reasoning backward from there. In year 3 at this rank, an associate on your team sources a company you almost pass on twice before finally taking the meeting, and 18 months later, it's the one deal in your entire portfolio that returns the whole fund by itself, which is closer to how venture math really works than anyone tells you going in, where roughly 2% of investments generate the majority of an entire fund's returns, and the other 98% mostly wash out or return modest multiples. Nobody remembers by exit. You take the associate to dinner to thank her. You do not tell her that you nearly didn't take the meeting she pushed for twice, because you're honestly not sure what she'd do with that information, and you're not entirely sure what you'd do with it either. The base moves to $450,000, but the number that actually matters is the carry, typically 2 to 3% of the fund's total profit share, vesting over the fund's 10-year life and worth somewhere between $2 and $8 million if the fund performs, worth close to nothing if it doesn't. You sign term sheets now. Your name is the one a founder remembers if the company becomes something, and the one nobody outside the industry will ever learn if it doesn't. You sit on 6 boards, and when a company you championed at Series A misses its Series C entirely, runs out of runway, and has to lay off 60 people, the board deck, with that outcome, has your name in the attendee list going back 3 years, in a way that no associate's or principal's name ever does, because votes carry consequences that memos don't. At the firm's annual offsite, a founding partner mentions, almost as an aside, that the fund has backed over 200 companies across its history, and that maybe 6 of them account for essentially the entire realized return, a ratio the room absorbs without much visible reaction, the way people absorb a fact they'd already assumed but never heard confirmed out loud. Your own carry statement arrives twice a year, a single page showing paper value that moves more with market sentiment than with anything the portfolio companies did that quarter, and you've stopped opening it the day it arrives, waiting instead for a weekend when the number, whatever it is, won't follow you into a Monday. Compensation stops being negotiated annually and becomes a share of the management company itself, typically 15 to 25% for a founding or senior GP, on top of carry across every fund the firm has ever raised. You are one of 5 people who decide. In a room nobody outside, the partnership enters. Whether the associate who found this year's breakout deal makes principal on schedule or waits another cycle, using a rubric that officially weighs judgment, origination, and cultural fit, and unofficially weighs whether the existing partners are willing to dilute their own economics to make room for one more name on the door. You raise the fund's 6th vehicle that year, $600 million, the largest in the firm's history, and your own name sits in the marketing deck LPs receive before they ever meet you in person. The deck cites a metric called DPI, distributions to paid in capital, the actual cash returned to investors rather than the paper markups everyone privately knows can evaporate, and your fund's DPI on Vehicle 4 is genuinely strong, driven almost entirely by the one company in 50 that returned the whole thing, the associate's company, the one you almost didn't meet. The associate who found that company is now a principal herself, 3 years ahead of the typical timeline, and when her name comes up in the promotion room, you're the one who mentions the deal first. Though saying it, you realize you can no longer separate advocating for her from quietly reassuring the room about your own judgment in almost taking a pass on it. You are one of the people junior analysts across the industry now try to get 15 minutes with, the same 15 minutes you once fought for with partners who barely remembered your name afterward, and you try, most of the time, to actually remember theirs. The management company's 20%, split 5 ways with tenure and fundraising contribution, factored in unevenly, means the newest GP in the room earns meaningfully less from the fee stream than the founding partners do, a gap everyone understands, and nobody at the partnership offsite ever quite says out loud. There is someone your entire firm depends on who never appears at any level of this ladder. She is 41, director of alternative investments at a state university endowment managing $18 billion, and she allocates roughly $400 million of it across 90 private fund relationships, yours among them. Her salary is $230,000, less than what a mid-level principal at your firm earns, and she does not source deals, sit on boards, or take a single carry point on anything. Last quarter, she recommended a $60 million commitment to your sixth fund based on your DPI history, your team's retention, and a 90-minute call in which she asked 11 questions, the 11th of which about what happens to the firm's returns if your two best-performing partners leave within 5 years. You answered well, but not perfectly, and she noted that. She will decide, 4 years from now, whether her endowment re-ups into Fund 7. If she and 3 allocators like her decide not to, your fund raises less, backs fewer companies, and the entire structure beneath you, the principals fighting for board seats, the associates cold emailing 40 founders a week, quietly contracts to fit whatever she and people like her think it should be worth. She goes home at 6. She will think about your fund again in April for the length of one quarterly call, and then move to the next line in a spreadsheet with 89 other funds on it. You have never spoken to her. You never will, most likely, beyond the 90 minutes once every 4 years, when your fund's future gets settled in a conference room you're not permitted to attend.